Welcome back investors to a new video. Most companies spend years trying to become important in just one industry. But today's company has quietly done something far more interesting. It has positioned itself across multiple industries at once: telecom, solar, battery storage, railways, data centers, and defense. And that immediately makes you stop and ask one simple question. How did one company end up sitting in the middle of so many different infrastructure opportunities? Because once you look at it properly, this is not really a story about 6 separate businesses. It is a story about one common theme. India is entering a phase where a huge amount of physical infrastructure has to be built. And the companies that can actually execute that build out are the ones that become impossible to ignore. Now, if we move from that bigger picture to the numbers, the scale becomes even clearer. The country is currently at around 275 gigawatts of peak power demand, and that is expected to move towards nearly 700 gigawatts by 2036. To support that kind of expansion, India will need massive investments in solar power, battery storage systems, telecom infrastructure, data centers, transmission networks, and railway modernization. And the challenge is simple but big. This entire infrastructure does not just need to be planned, it also has to be built. That means engineering, procurement, execution, manpower, approvals, delivery, and long-term maintenance. That is why EPC companies become so important in a cycle like this. Now think of modern infrastructure as a living city. Electricity keeps it running, telecom networks keep everyone connected, data centers power its digital brain, railways keep people and goods moving, and defense systems protect everything that makes the city function. Every one of these sectors is currently witnessing a large investment cycle. India's renewable energy capacity expansion, telecom network upgrades, battery storage deployment, railway modernization programs, and data center construction are all happening simultaneously. That creates a massive opportunity for companies that can execute projects across multiple infrastructure segments. And when you zoom in on energy, the scale becomes even more interesting. The global solar market is expected to grow from around 2.35 terawatts in 2025 to around 7.25 terawatts by 2031, representing nearly 20% CAGR growth. The drivers are straightforward. Electricity demand is increasing, governments are pushing for cleaner energy, solar power costs have fallen significantly, corporate buyers are increasingly signing long-term power purchase agreements, data centers are consuming massive amounts of electricity and are increasingly sourcing renewable power. In India, the government is targeting 500 gigawatts installed capacity by 2030, where a large part of this addition is expected to come from renewable energy. This creates a multi-decade opportunity for solar developers and EPC contractors, and in regards to today's company, understanding the solar sector is crucial. So before we even come to the company itself, let us first understand the solar value chain. Think of a solar power plant like a restaurant. When you visit a restaurant, you only see the food on your table. But behind that meal is an entire ecosystem working together. The ingredients are like the solar panels. They make everything possible. The chef is like the inverter, transforming those ingredients into something people can actually use. The kitchen is like the mounting structure that holds everything together. The waiters are like the transformers and cables, delivering the final product to the customer. The manager is like the monitoring system, ensuring everything runs smoothly. And the refrigerator is like the battery storage system, storing extra resources for later use. Building the restaurant also involves choosing the location, designing the kitchen, buying equipment, opening the restaurant, and managing it every day. A solar plant follows the same journey: project development, engineering, procurement, construction, testing, and long-term maintenance. Most investors only see the food, or in this case, the solar panels. The real opportunity lies in the entire restaurant operating behind the scenes. And that is exactly where one company has quietly transformed itself from a telecom infrastructure contractor into a diversified renewable energy and infrastructure platform. Over the last decade, this company installed more than 13,000 telecom towers, laid thousands of kilometers of optical fiber cable, built solar projects across India, and created manufacturing capabilities across multiple infrastructure products. Today, it is positioning itself for the next phase of growth through solar EPC, solar IPP, battery energy storage systems, data centers, railways, and defense. Apart from solar and telecom, the company also has product manufacturing, which includes telecom poles, transmission towers, solar MMS, crash barriers, industrial cable trays, BLDC motors, LED products, and solar street lights. It also offers building materials, including autoclaved aerated concrete blocks, jointing mortar, wall plaster, and wall putty solutions, as well as lifestyle products such as UPVC profiles, UPVC windows and doors, and aluminium windows and doors. Operations and maintenance includes telecom tower maintenance, optical fiber maintenance, solar plant maintenance, and data center maintenance opportunities. This diversified structure gives the company exposure to multiple infrastructure spending cycles rather than relying on a single sector, and it also helps support current projects and add towards revenue generation. So the company we are discussing today is Bondada Engineering. And the place to start is telecom because that is where the company built its backbone. Telecom may not sound exciting, but it is one of the most important infrastructure layers in the country. Every time you make a call, send money, stream a video, or join an online meeting, there's a physical network working behind the scenes to make it happen. Bondada built that base over years. It has deployed more than 13,000 telecom towers in India over the last 14 years, and it services more than 38,500 telecom towers and 1,21,873 kilometers of OFC network through O&M. This is not a new player. This is a company that has spent years building execution capability in one of the most operationally intense sectors in infrastructure. Telecom EPC is not a simple business. It starts with tower design and foundation construction, then moves into vertical assembly, power systems, testing and commissioning. Telecom O&M is equally important because towers and fiber networks need continuous maintenance, fault fixing, power backup support and service management. Bondada has long-standing relationships with clients like Reliance Jio, Airtel and BSNL, which tells you the company has already built credibility in this space. There is also a telecom demand story behind Bondada's base. India's telecom tower network is huge with nearly 754,000 towers and about 2.3 million base transceiver stations in the country. The country's 4G saturation work is still ongoing, BSNL's 4G saturation project is ongoing, and 5G rollout in Tier 3 towns is still limited by fiber reach. Bondada participated in most BharatNet Phase 3 packages. Telecom O&M margins are currently lower at around 7% to 9%, largely because of the Reliance Jio O&M contract, which itself forms about 70% of O&M. Management expects margins to improve as BSNL 4G O&M ramps up. But telecom was only the base. The real transformation starts when you move into solar. Bondada's solar business is built around three revenue streams: solar EPC, solar O&M, and solar IPP. Solar EPC is the biggest contributor today. Bondada operates in the downstream execution side of the solar value chain. It focuses on project development, engineering, procurement, construction, commissioning, and O&M rather than manufacturing solar modules or inverters. The solar plant itself includes panels, inverters, mounting structures, BOS wiring, transformers, switchgear, energy storage, monitoring systems, and protective equipment. And investors, we also find these small cap, micro cap, and SME opportunities at an early stage through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance, and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential. Now let's get back to our video. And the EPC is a turnkey business where the contractor handles the project end to end. Engineering covers site assessment, system design, and structural planning. Procurement involves sourcing panels, inverters, mounting structures, and other equipment, often at scale for better pricing. Construction is the physical build, followed by testing and commissioning. That is where Bondada is active. The company also notes that solar EPC contracts can benefit from viability gap funding, where government support can cover up to 30% of project cost, and the capex is around 1.8 to 2 crore rupees per megawatt. Management expects EPC ROCE to improve further as larger projects are executed. Solar operations and maintenance is Bondada's next growth layer. The company manages panel inspection, cleaning, testing, performance monitoring, repairs, and compliance for solar plants with a current portfolio of 20 megawatts. Operating on 3 to 5 year maintenance contracts, it generates recurring revenue, delivers around 10% PAT margins versus 7.5% for solar EPC, and provides better earnings visibility and business stability. Also, as the company gets new EPC projects, O&M revenues from these will come to the company, creating additional revenue streams. And solar IPP is where the business gets even more interesting. Bondada is expanding into the solar independent power producer segment, where it will develop, own, operate, and maintain solar power assets while selling electricity under long-term PPAs. Unlike the EPC business, which generates one-time project revenues, The IPP model is expected to provide recurring, long-term cash flows through power generation and sale. Solar IPP revenues are expected to commence from FY28 as projects become operational. Given the long-term nature of PPAs, the business is expected to generate stable and predictable revenue streams compared to EPC projects. The company has a 2 gigawatt solar IPP plant under execution in Andhra Pradesh. The difference between solar EPC and solar IPP is really the difference between executing a project and owning the asset. A solar EPC business is a construction and engineering contractor. It handles the engineering, procurement and construction of a solar project for a client who could be a utility, a corporate buying solar for captive use, a government body or even an IPP. The EPC company designs the system, sources panels, inverters and other equipment, builds the plant and hands it over once commissioned. Once the project is delivered, the EPC's job is largely done, aside from warranty obligations or sometimes an O&M contract layered on top. Revenue comes from project fees, usually billed in milestones tied to construction progress. Margins are thinner and capital tied up is for a short duration because the company is not holding the asset long term. Growth depends on winning a steady pipeline of projects, so it is cyclical and dependent on tendering activity, input costs and execution efficiency. Working capital management and project execution risk are the main concerns. A solar IPP business, by contrast, is about owning and operating the power plant for its entire life, typically 20-25 years. An IPP develops or acquires a solar project, arranges financing, usually with a mix of equity and debt, and then earns revenue by selling electricity under a long-term PPA with a utility, government distribution company, or corporate buyer. The IPP's revenue is an annuity stream of electricity sales over decades. Profitability depends on the tariff locked in, the generation performance of the asset, and the cost of capital used to finance the plant. Because IPPs hold the asset on the balance sheet, this is a far more capital-intensive business with high upfront investment, and returns are realized slowly over the life of the asset rather than upfront. The risks are different too. Counterparty or offtake credit risk, regulatory and policy risk, interest rate risk, resource risk, and long-term asset performance. In practice, these models work together. An IPP will typically hire an EPC contractor to actually build the plant it intends to own and operate. Some large companies operate both arms since the construction expertise is the same regardless of who ends up owning the plant. The core distinction is simple. EPC is a project-based contracting business focused on execution and near-term cash flow, while IPP is an asset ownership business focused on long-term, capital-intensive returns from selling power. And that is exactly why the biggest structural shift in Bondada is so important. The company is moving from being a pure EPC contractor to becoming an asset owner with recurring annuity-like income, essentially shifting from build and walk away to build and keep earning. The concrete vehicles for this shift are Solar IPP and BESS BOO. Under Solar IPP, Bondada will own and operate solar assets and sell power under long-term PPAs, with revenue only starting from FY28 but eventually contributing an estimated 20 to 25% of total revenue at 17 to 18% IRR. Under BESS BOO, it owns battery storage assets and earns rental and annuity income over roughly 12-year contracts at 12 to 13% IRR alongside an 850 megawatt BOO project already underway in Andhra Pradesh. That naturally brings us to BESS. Solar power has one major problem. The sun does not shine 24 hours a day. Electricity demand is continuous. This mismatch creates the need for battery energy storage systems, or BESS. A BESS stores electricity during periods of excess generation and releases it when demand increases. Think of it as a giant rechargeable battery for the power grid. As renewable energy penetration increases, battery storage becomes essential rather than optional. Now, just like solar, there are two ways to participate in this opportunity. The first is BESS EPC, which stands for Engineering, Procurement and Construction. The contractor designs, procures equipment for, and builds the BESS facility for a client, then hands it over. Revenue is one-time, lump sum or milestone-based payment for construction work. Once commissioned, the contractor's job is done, unless it also wins a separate O&M contract. Ownership and operational risks sit with the client. Cash flow is front-loaded and project-based, with revenue recognized during the construction period, typically 12 to 18 months. Think of it like a builder constructing a house for someone else and getting paid for construction, then walking away. The second model is BESS BOO, which stands for Build, Own and Operate. The company builds the facility using its own or financed capital, retains ownership and operates it for the contract duration, earning revenue from the utility or grid operator over a long period, often 10 to 12 years, through capacity payments, tariffs or annuity-style contracts. Revenue here is long-term recurring income, often supported by viability gap funding from the government to make the project bankable. The developer bears asset ownership risk, financing risk and operational risk, but gets steady, predictable cash flows over the contract life. Think of it like building a rental property and collecting rent for years instead of selling it after construction. But India is still at a very early stage of battery storage deployment. India may require around 35 gigawatts of storage by fiscal year 2027, around 160 gigawatts by 2030, and around 1,840 gigawatts by 2047. The company is targeting 2 gigawatts of BESS installations by 2030, and an 850 megawatt BESS BOO project in Andhra Pradesh is already underway. It also sees potential annuity-style income streams extending for around 12 years. The management has even revised its long-term target from 10 gigawatts to 25 gigawatts by 2030 across solar and storage opportunities, including approximately 16 gigawatts of solar and 9 gigawatts of BESS. Now, let us come to the other industries. Data centers are another strong growth market. AI, cloud computing, streaming services, and digital applications are driving explosive demand for data centers globally. Bondada is gradually entering this ecosystem. The company has already been empaneled with Microsoft for O&M activities at Hyderabad. Management estimates that O&M services for a 25 megawatt data center can generate approximately 8.4 crore rupees in revenue per year. The company has also signed an MOU with Bryanston for data center EPC. Over time, management expects these data centers to contribute around 7% to 8% of revenue, with EBITDA margins of around 14% to 15%. Railways is another underappreciated opportunity. Indian Railways is expected to spend approximately 10,000 crore rupees annually on safety infrastructure. Bondada is focusing on opportunities such as Kavach 2.0, crash barriers, telecom infrastructure, and railway communication systems. The company already has a railway order book of approximately 193 crore rupees in FY26 and has participated in tenders worth nearly 600 crore rupees. Management believes railways could contribute 20% to 25% of company revenue over the next 5 to 10 years, and margins will also be higher than solar and telecom. Defense is also part of the story. Bondada is entering defense and plans to focus on land systems, aerospace, UAVs, naval systems, electronics and avionics, and defense infrastructure. Management plans approximately 70 crore to 100 crore rupees of defense-related capex and has already received initial defense orders. Importantly, defense products can significantly improve margins compared to traditional EPC projects. The company's FY26 solar order wins are very important because they show the scale of the business. The key takeaway from Bondada's order book is that the business is no longer dependent on telecom. Solar and BESS now account for the majority of growth visibility, while railways, products, and defense provide additional diversification. The company has bids in pipeline worth 25,000 crore to 30,000 crore rupees, and the win rate is around 25%. The total order book as on FY26 is 7,147.5 crore rupees, which is almost 2.5 times the revenue of FY26. Out of this, solar EPC and IPP order book stood at 4,536.7 crore rupees in FY26. In addition, the company has a 9,000 crore rupees solar IPP and BESS pipeline linked to 2 gigawatt solar IPP and 2 gigawatts BESS, of which 2,000 crore rupees is already under execution. The timeline for completion is around 3 to 4 years. Notably, this 9,000 crore rupees opportunity is not included in the reported order book as it will be executed through SPVs. The key FY26 solar order wins included the 1,050 crore rupees Adani order, the 945.1 crore rupees NLC India Renewables order, the 465 crore rupees MHA GENCO order, and the 391.4 crore rupees NTPC Green Energy order. Diversification beyond solar is also visible. BESS BO order book stood at 1,463 crore rupees in FY26 with an average execution timeline of 18 months. During the period, the company secured two significant BESS BO projects. These orders included a project from TNGECL with a power capacity of 200 megawatts and an energy storage capacity of 400 megawatt hours valued at 836 crore rupees, and another project from AP Transco with a power capacity of 225 megawatts and an energy storage capacity of 450 megawatt hours valued at 627 crore rupees. Telecom order book was 785.4 crore rupees in FY26, Railways was 193 crore rupees in FY26, Products stood at 168.8 crore rupees in FY26, and Defence started with an initial order of 40 lakh rupees from Bharat Electronics. Now let us come to the numbers, because a strategy only matters if the numbers improve. Over the last 5 years, Bondada has delivered a revenue of 2,842.81 crore rupees in FY26, which translates into a CAGR of approximately 58% for 5 years, driven primarily by the rapid scaling of its solar business, which now contributes nearly 80% of revenues. More importantly, growth has not come at the expense of profitability. PAT has grown from just 9.21 crore rupees in FY21 to 211.08 crore rupees in FY26, indicating that the company is benefiting from both scale and operating leverage. ROCE has improved from approximately 29% in FY21 to 40% in FY26. That is particularly notable given the capital-intensive nature of EPC and infrastructure projects. Working capital has improved from 125 days to 107 days. The company remains largely debt-free and generated approximately 125 crore rupees of operating cash flow in FY26. These are important signs because the next phase of growth, solar IPP and BESS BOO, will require substantial capital. A strong balance sheet provides flexibility. Now let us compare Bondada with peers more broadly. Vikram Solar has a strong solar manufacturing presence and backward integration, but lower operational efficiency compared to Bondada. Acme Solar has a large renewable portfolio and established IPP presence, but lower ROCE and a higher debt burden. Sterling and Wilson Renewable Energy has large-scale global EPC capabilities, but also margin volatility, exceptional losses, and higher leverage. Compared to these, Bondada currently enjoys healthier profitability and cleaner balance sheet positioning. In BESS, Prostam has exposure to the segment, but it is smaller in scale and has a lower ROCE. Bondada currently appears to have stronger operational capabilities. Pace Digitech has higher net margins, but also higher debt and negative CFO due to receivable buildup. Compared to Bondada, it has a similar growth profile, but weaker cash flow quality. Now let us come to the future outlook, because the management vision ties everything together. Management is not trying to build another telecom or solar EPC contractor. The long-term vision is to become a leading defense engineering, manufacturing and services partner by 2030, playing a pivotal role in India's self-reliant defense ecosystem and contributing to the global defense supply chain, with strong revenue growth from both domestic and export markets. The journey started with telecom, which gave the company execution capabilities, project management expertise, and relationships with large corporates and PSUs. Management then leveraged these strengths to enter solar EPC. Bondada has a target of revenue of $1 billion by 2030. The key takeaway is simple. Bondada is no longer just a telecom EPC contractor. It has evolved from telecom to solar EPC and is now building recurring cash flows through solar IPP assets while creating optionality in BESS, data centers, railways, defense and infrastructure manufacturing. The real story is not where the company is today, but where management aims to position it for the next decade. A diversified infrastructure platform aligned with India's long-term renewable energy and infrastructure growth cycle. Identify such small cap, micro cap and SME companies early through our research services, Emerging Titans and Tiny Titans. Emerging Titans is mainly built for mainboard small and mid cap companies, while Tiny Titans focuses purely on SME listed stocks. Across both services, you receive detailed research reports, entry and exit strategy, allocation guidance and regular updates. So if you want to be part of our research community, you can visit valueeducator.com or check the link in the description. We follow our sprint strategy framework to discover such niche stocks with strong potential. That's it for today's video. If you found this detailed breakdown useful, then like the video, subscribe to the channel and comment below sprint if you like the detailed research. We will meet again next Saturday with another video at 11 AM.